Welcome to Chapter 9, Banking and the Management of Financial Institutions. Chapter 9 examines how banks attempt to maximize their profits. In this chapter, we will learn how to summarize the features of a bank balance sheet, apply changes to a bank's assets and liabilities on a T account, identifies ways in which banks can manage their assets and liabilities to maximize profit, and list the ways in which banks deal with credit risk. There are 6 main general principles of bank management: liquidity management, asset management, liability management, capital adequacy management, credit risk, and interest rate risk. Here we have the typical balance sheet of a commercial bank. On the left, we have assets, which include reserves, cash items in process of collection, deposits at other banks, securities, loans, and other assets. On the right, we have liabilities, which generally include checkable deposits, non-transaction deposits, borrowings, and bank capital. Both sides must equal each other, much like any other balance sheet. Here we have an example of basic banking. In this example, we can see that the opening of a checking account leads to an increase in the bank's reserves equal to the increase in checkable deposits. We can also see that when a bank receives additional deposits, it gains an equal amount of reserves. When it loses deposits, it loses an equal amount of reserves. Here we have an example of excess reserves. Suppose a bank's required reserve ratio is at 10%. The bank on the right is meeting that required reserve at just 10%, whereas the bank on the left is at 20% reserves, meaning they have an excess. If a bank has excess reserves, a deposit outflow does not necessitate changes in the other parts of the balance sheet. Here we see the shortfall of having just the required reserves. When $10 million is taken out, the bank on the right has 0 reserves, whereas the bank on the left has $10 million in excess reserves, still meeting the reserve requirement ratio, whereas the bank on the right needs to sell off loans or other assets in order to meet that required ratio. Here we can see what borrowing does to the balance sheet of a financial institution. Borrowing increases the liabilities by the amount needed to meet the required reserve ratio. Although borrowing also comes with a cost incurred, which is the interest paid on the borrowed funds. Expansion of overnight loan markets and new financial instruments such as negotiable CDs and recent phenomenon due to the rise of money center banks has made this a more accessible form of acquiring the necessary money to meet the required reserve ratio. Another way of acquiring the funds necessary to meet the reserve requirement ratio is by selling securities. As we can see in this example, the sale of about 9 million securities instead of borrowing from open money center banks will meet the reserve requirement ratio and not cost any money in interest rates paid on the funds borrowed. A third way of acquiring the funds necessary to meet the reserve requirement ratio is by borrowing funds from the Fed. In this example, we can see that $9 million was borrowed from the Fed. A cost will be incurred, which is equal to the interest rate that is necessary to be paid on the funds. A fourth way of filling the reserve requirement ratio is by reducing loans. In this example, we can see that the bank has sold off $9 million in loans to meet the reserve requirement ratio. However, a reduction of loans is one of the most costly ways of acquiring reserves. It also antagonizes customers, having a negative effect on future relations. And other banks may only agree to purchase these loans at a substantial discount, leading to further losses in finances. Here we can see how bank capital helps prevent bank failure. The amount of bank capital also affects the return for the owners or equity holders of the bank. Bank capital is also a regulatory requirement. There are trade-offs between safety and returns to equity holders. There are benefits to the owners of the bank by making their investments safe. It is also costly to the owners of a bank because the higher the bank capital, the lower the return on equity. The choice depends on the state of the economy and level of confidence. Here in this example, we can see multiple ways of assessing bank capital and the return on assets, equity, and the relationships between those two. Because of the global financial crisis, there have been multiple steps and procedures put in place to ensure that our banking sector does not fail once again. A couple of these are screening and monitoring. There's also put larger emphasis on long-term customer relationships, loan commitments, collateral and compensating balances, and credit rationing. Managing interest rate risk is integral to operating a bank. Here we can see an adequate way of managing this interest rate and spreading out the risk equally throughout rate-sensitive liabilities and fixed-rate liabilities, along with rate-sensitive assets and fixed-rate assets. Here we have a basic gap analysis, which is the bank profit, which equals the rate-sensitive assets minus the rate-sensitive liabilities multiplied by the interest rate. There's a maturity bucket approach, which measures for the gap for several maturity subintervals, and there's the standardized gap analysis, which accounts for different degrees of rate sensitivities. The gap analysis uses the weighted average duration of a financial institution's assets and of its liabilities to see how net worth responds to a change in interest rates.